Okay, hi everyone, welcome to today's webinar. So before we get started, we'll give about another 1 to 2 minutes to let more people join our session. In the meantime, let me know if you guys can see me and hear me clearly. Today's webinar will be on multi-time frame trading. There shouldn't be too many slides to cover, so we should have some time at the end to go through some charts. So if you guys have any requests, I'll take whatever requests you guys have and go through as many charts as we can at the end. So yeah, we'll give another maybe 1 more minute. Thanks everyone. Oh, let me enable the chat. Okay, should be fine now. Yeah, okay, great. We'll give 1 more minute to let more people join and then we'll go ahead and get started. Okay. So as per usual, a disclaimer and risk warning. This information is not considered investment advice or an investment recommendation, but instead a marketing communication. Our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risks involved. So I'm Melanie, and I'll be your speaker for today. I'm an investment analyst at Rocket, who are finalists for Best FX and Equity Research in the years 2019 to 2021. So here's our agenda for today. We'll start off by talking a bit about which time frame is the most important, how to take a top-down approach, some things to look out for in the higher time frames, zooming into the lower time frames, and how to craft your strategy. Okay, we'll start off with a bit of basics, because this you'll see how this leads in a bit. Starting off, support and resistance levels in trading, as you would know, refers to the price at which an asset's price tends to stop falling, which would be our support, or stop rising, which would be our resistance. So to identify these levels, we use technical analysis tools like trend lines, moving averages, and chart patterns. Another way to identify these levels is by looking at some swing lows and swing highs of the asset, as well as maybe volume data to identify potential levels of support and resistance. Okay, so here you can see how we can use swing highs and swing lows as resistance and support levels, but we'll go through a bit more in depth on what to look out for when we're trying to identify these levels. So this is an example of insignificant swings. So you can see the swings are a bit too small, the movements are quite insignificant. And these are best to use for any trend lines or any Fibonacci trend lines as well, including support and resistance levels. Okay, so here's another incorrect example. Okay, so here's a correct example of significant swings. There's a very clear move up and down, and with very obvious peaks and troughs and clear market movements. So these swings will be good to use for your support resistance levels, Fibonacci, and also even for your other indicators as well. Okay, here's another example. So we've drawn out exactly how clear your peaks and troughs should be. So you can use your support and resistance levels as your take profit and stop loss levels. So that's why these levels are really important. But you shouldn't use an entry if there are no other supporting arguments, such as Fibonacci or other graphical levels to support your analysis. So using a recent swing high or low is considered a weak level if that's the only level that you're relying on. Okay, so multiple swings. So if at least um, two swing highs or lows levels line up nicely, then it's a much better level to use. So you want to try to find areas where these might line up. So it doesn't have to be at the exact level, as long as it's kind of near that area, that's good enough. So a good habit is to try and see how far back your resistance or your support line can go. So it's okay to cut through small wicks since these are typically considered areas instead of specific levels like we see in this GIF here. Okay, so now that we know how to identify significant swings and how to use them as support and resistance levels, we'll look at some things to look out for when inputting a support and resistance level. So basically how to pick a starting point. So when you're picking a pivot or entry level, there are a couple of rules. Firstly, you want to check if there's a swing high or low, pullback or overlap level to start from. Um, Next, you want to go as far back as possible, like we talked about earlier. And intersecting the wicks is preferred, which we talked about earlier as well. So in this example, you can see the green thumb, that's what we're looking for normally with a swing high, just cutting the wicks. The orange thumbs are okay, but not really preferred, but not exactly wrong as well. So here's another example. There's a red thumb, which shows that this is what you should avoid because it's cutting too many bodies of candlesticks at the first swing high, so you want to avoid this. But you can look at the others where it's just cutting the wicks. Okay, once again, the red highlighted area is intersecting too many candlesticks. So it's very messy, whereas here you have very clean cuts of the candlestick wicks. Okay, so all this is to show you that this is an example of a clear market structure. So Fibonacci retracements can be used. Fibonacci retracements, support and resistance, all of that can be found in both choppy and trending markets. But it's really important to look for clear market structure because it makes your analysis more, firstly, it's easier to conduct your analysis. Secondly, it makes it a little bit more effective. So you can see what we talked about earlier, the clear swing highs and swing lows. So here's an example of an unclear market structure. You can see it's very choppy. There aren't very clear swing highs or swing lows. And it's a bit harder to do your analysis on this. Okay, so which time frame is the most important? So one thing that we can do to find clearer market structures is adjust your time frames so that the market structure is clear. So for example, if we look at the previous slide, an unclear market structure, just because you open a chart and it looks like this doesn't mean that you can't use it completely. You can still adjust the time frame and look for market structure that's clearer on the different time frames. So what might look messy on your M30 chart might look very clear on an H4 or H1 chart. So if there's too much chaos on the shorter time frames, you're still able to take a step back or sometimes a step forward to get a clearer view. So here's an example. On our 15-minute time frame, okay, also we normally don't go anything below 15 minutes. So like your 5-minute and 1 minute, we try to avoid those because it gets a bit noisier on the shorter time frames and a bit harder to analyze. So here's an example of an unclear market structure on 15-minute time frame. It's quite messy. There's no clear movement in price. But when we change it to the H1 time frame, we can see the highlighted portion, which is the market structure we looked at on our M15. It's much clearer, and hence easier for us to analyze. So there's two criteria that we should look out for. Firstly, a clear swing low and swing high. Secondly is a clear trend between the starting and ending point. So this starting and ending point refers more to trend lines or drawing trend lines for your Fibonacci retracement. In this case, this also applies to support and resistance levels that we talked about earlier as well. Yep, we use 30-minute as well. So 30 minutes fine. M15, M30, just nothing below M15. So like M1 and M5. We try to avoid those. Okay, so now let's do a brief intro into multi-time frame analysis. So it's basically a trading strategy that involves analyzing the market from multiple time frames. Self-explanatory. But this can help beginner traders because you can get a better understanding of the market from the different time frames and hence make more informed trading decisions. So the first step, typically traders will choose at least two time frames, such as a short-term time frame, example 15 minutes, and a longer term time frame, so 1 hour or daily. So the short-term time frame is used to identify the most recent trends and price movements, while the longer-term time frame is used to identify the overall trend and market direction. So once the time frames are selected, you can then analyze the market from each time frame, looking for key support and resistance levels, like we talked about earlier. You can also look for your trends or patterns. So for example, if the shorter term trend is bullish and the longer term trend is also bullish, this could indicate a strong uptrend in the market. So you can then use this information to make trading decisions. So for example, if the short-term trend is bullish, you might look to buy on dips or pullback levels in the market. Conversely, if the longer-term trend is bearish, you can look to sell or short in the market. So yeah, so it basically helps you to look at the bigger picture and analyze trends and patterns from multiple different time frames. Okay, any questions so far? Okay, so what should you look out for on the higher time frames? Firstly, key graphical levels. So those are the levels we talked about, the horizontal levels, support, resistance levels, trend lines, trend channels, breakouts, Big moving averages like your 50, 100, 200, golden cross and death cross, your Ichimoku cloud, big Fibonacci levels like your retracements, extensions, and projections, and price action, especially the prior bar. So price action basically refers to your past, present, future momentum from the previous bar, and you're looking at that momentum to dictate your strategy. Okay, so now types of trading on the higher time frames. Firstly, we have trend trading. So this involves identifying and trading with prevailing market trends. This is a bit easier to understand. So you basically aim to enter positions in the direction of the dominant trend and hold them until the trend shows signs of reversal. So this strategy often will involve the use of technical analysis tools to identify and confirm trends. So if you've been with if you've participated in my previous webinars, when we do our live analysis, I'm always looking at quite standard Fibon not Fibonacci indicators that tell me the overall trend or the overall momentum. Those would be like your moving averages, parabolic saw, Ichimoku, MACD, things like that. Next is swing trading. So swing trading refers to capturing shorter term price swings within a larger trend. So you aim to enter positions at swing highs or lows and take the profits as price moves in your favor. So this strategy typically involves holding positions for several days to weeks, taking advantage of price oscillations. So this works better for longer term trading. Next is breakout trading. So breakout trading involves entering positions when the price breaks through key support or resistance levels. So traders will look for strong momentum and volatility following a breakout and aim to profit from continued price movement in the breakout direction. So this strategy requires kind of constant analysis, I would say, of price patterns and volumes so that it confirms your breakouts. And lastly, we have mean reversion trading. So this is based on the idea that prices tend to revert to their average or equilibrium levels after deviating from them. So traders identify overbought or oversold conditions and take positions with the expectation that prices will eventually revert. So this strategy often involves the use of technical indicators again to identify potential reversals. So if you're familiar with divergence trading, using your stochastic and RSI, this could be one of the indicators that you use to identify potential reversals. Okay, any questions so far? Okay, great. Um, let's move on. I normally like to start off on the higher time frames. So I'll look at weekly first just to get a general idea of the direction that prices are headed towards. Um, but I won't do any analysis on that. I just look at the direction. And then I will zoom in to both the 4 hour and the 1 hour time frames. So choosing between the two, I just look at which chart has a clearer market structure, like what I just went through in a couple of slides ago. Yeah, I just look at I just compare the two on H1 and H4 and see which charts look nicer or have a clearer market structure and are easier for me to analyze. So I guess H1 and H4. Okay, so let's zoom into the lower time frames. So scalping, firstly, is a high frequency trading strategy where traders aim to make quick profits from small price changes. So they open and close multiple positions within a short period, sometimes within seconds or minutes, and you're trying to capture these small price differentials. So scalpers will often rely on technical analysis indicators. Again, these will include your moving averages or oscillators to identify these shorter term trading opportunities. Day trading. So day trading involves opening and closing positions within the same trading day without holding positions overnight. So day traders will often focus on intraday price movements and make multiple trades throughout the day. So they aim to take advantage of short-term trends or volatility. Um, Again, technical indicators, of course, chart patterns, and also real-time market data, especially if you are looking at um, Forex. So if a uh, economic data announcement is scheduled, it's important for you to look at the results. If it coincides with the time that you're trading, you should look at the results um, when you are making your trading decisions. Number three, momentum trading. This focuses on capturing strong price moves driven by increased buying or selling pressure. So traders will look for stocks or assets that exhibit significant price momentum and then enter positions in the direction of the prevailing trend. So for this, like I mentioned earlier, it's pretty similar to the higher time frame where we talked about momentum as well. But for this, we use RSI, MACD, um, RSI, MACD mostly to identify momentum opportunities. And lastly, of course, news trading, which I briefly talked about, which obviously involves taking advantage of significant market moves that result from news events or economic data releases. So traders will tend to closely monitor news announcements and enter positions based on the impact of the news on the market. So you'll aim to capitalize on the price volatility post announcement or post data release, and the rapid market reactions that occur immediately following news releases. Okay, so now that we know how to identify significant swings, use them as support and resistance levels, and we also know the different types of trading, I suppose. Let's look at crafting your strategy. Um, I also see somebody has asked um which time frame is suitable for scalping. Yeah. So let's get into that now. Okay. So scalping uses the shorter time frame, like we mentioned earlier. It's fast-paced, it's exciting, um, and it's quite emotional as well. Um, So it's short time periods between the opening and closing of a trade. You are basically grabbing very small amount of pips, but you're also risking small amount. So you are taking advantage of market volatility and you're able to avoid known unknowns. So your locus of control is 20 pips versus 200 pips. Then there's new opportunities every time you open the chart. Okay, so to answer your question, holding time is from a few seconds to a few hours. How we would do it is 1 hour in the morning, 1 hour in the afternoon, and 1 hour in the evening. So for this, which timeframes would you use? Anything below the H1, since we're only spending 1 hour looking at our charts. Um, how do you call overnight trading? And is it average days of closing or does it depend on spread and risk ratio? Um, Overnight trading basically means you are holding your positions beyond, so after market closes, right? So, yeah, the decision for you to close or leave it or hold it overnight depends on your market conditions, your spreads, and your risk tolerance as well. Um, what do you mean by is it any average days of closing? So I guess some benefits of holding overnight can be like earning interest if you're carrying trades over or you're exploiting price gaps from the news. But we normally will avoid overnight trades during high impact news events or illiquid periods to mitigate your risk. Oh, does it make sense to keep it open for many days? Um, well, it depends on your trading strategy. Like I mentioned, there are benefits to it, like capitalizing on your trends. There is reduced stress compared to like scalping that we're talking about. And you also gain interest. If you might earn swap interest if there's a positive carry on positions held overnight, but that depends on the currency pair. But when we talk about risk, there's definitely an increased risk or market volatility because of events like news releases or geopolitical developments that can cause unpredictable price movements. And also, if your swap is negative, so swap is basically your overnight interest. If it's negative, then it can eat into your profits. Yeah, but you can keep it open if your analysis indicates a high probability of that trend continuation. And also if you use proper stop loss orders and risk management techniques to protect against, any excessive losses and um yep, if price ends up moving in the opposite direction, then you should be fine. Okay, I hope that answers your question. Okay. Um Yeah. So if swap is positive, um, then it can make holding your position overnight more attractive. Yeah, because you're reducing holding costs and also earning interest. So yeah. Okay, let's move on. So we've talked about um how to go about scalping. Now we'll dive deeper into how are the three powerful scalping strategies. Firstly is the horizontal pullback strategy. So horizontal pullback is basically when price has already broken out of a resistance or a support level. So here we have three swing highs that line up nicely in this resistance, but price has broken out of this level. So it's broken out. So it's basically a pullback. We're calling a pullback because we're expecting price to retrace or pull back to that level. Okay. So this is, in this case, because it's a resistance, price has broken out of the resistance. We're now calling it a pullback support because we're expecting price to bounce off of it again. Here's another example. In this case, we have three swing lows lining up, and this is a swing low support. So price is broken below it, and we're expecting it to reverse back off this level. So this is now a pullback resistance. Okay, so you can combine this method with the different indicators that we talked about. Here we have a horizontal pullback resistance because price has broken below this swing low support, and we're expecting it to reverse off again. And we're also using it in line with this Ichimoku cloud. So here price is bouncing off the cloud, but it's also bouncing off I shouldn't say bouncing, it's reversing off the cloud and it's also reversing off this pullback level. Okay. And so we're expecting it to continue in a downtrend. Okay, we have a question. How long to hold your position so that the swap interest will not wipe out all your capital or receive margin call? Um, this depends on a couple of things. Okay, so firstly, your trade size, also your leverage. Because a higher leverage will increase the impact of your swap fees. So even a small move in the market against you can trigger a margin call faster if you're using a higher leverage. Of course, market volatility also counts because if the market moves strongly against your position, then your swap interest accumulates. Um, yeah, so you have to take into account a lot of different factors. So I can't tell you exactly how long. You can calculate, you can kind of estimate, I guess, like a safe holding duration. So you can calculate the swap per day. So if your um let's say for example, if your swap rate is negative, right? Um, if it's minus 0.5 points per day on and your position is maybe 100,000, right? Then your daily swap is $5. So by calculating your swap, you can kind of estimate how much that will eat into your profits. Um, yeah, I can't tell you exactly how long to hold your position because it depends on the size, depends on a lot of things. I think overall, when it comes to holding your position overnight, you just want to make sure that you have proper risk management in place. So firstly, you want to make sure that you're aiming for trades with positive swaps to offset the holding cost. Um, you maybe want to reduce leverage to minimize the impact of um, adverse price movements. You can also monitor the swap changes that can change, the swap rates, I mean, that can change due to interest rate shifts or if your broker adjusts it. Um, and also set time limits for how long you're willing to hold it. Yeah. So you can calculate it based on what I said about the points per day. But of course, again, that depends on how many hours you're holding for in the day as well. So yeah, I can't really give you a set answer. Okay, the second strategy for scalping, what was I talking about? Um, yeah, the second strategy is using Fibonacci retracement. So if you're unfamiliar with Fibonacci, we have an entire series, four-part series where we go in depth into each Fibonacci technique. I'll just briefly go through the very basic one here, which is Fibonacci retracement. So a couple of rules. Firstly, your Fibonacci trend line must follow the price structure clearly. Trend line can deviate from price structure, but not by too much, like we see in the GIF here. It shouldn't cut right through the price structure. Okay, instead, it should look something like that. Okay, where you are following the price movement quite clearly. Okay, so combining our Fibonacci retracement and the pullback that we learned earlier, here we have euro dollar, and prices are moving below our pullback resistance. So we're expecting price to continue to move upwards and reverse off this chart. So we're using our Fibonacci retracement to support this horizontal level. We have a 61.8 retracement, and we also have a 50% retracement that lines up in that same area. And you can see subsequently price did reverse off that pullback level. Okay, and in fact it headed all the way down here. Okay, next we're going to add in another indicator, which is the Ichimoku cloud. So for Ichimoku, there are many ways to use this indicator. We normally just like to focus on the cloud. So here, in general, when price moves above the cloud, it's a bullish signal. When price moves below the cloud, you can see it's a bearish trend. So here we see prices moving within the cloud, which suggests a transitionary stage or period. And we also have price moving in this descending trend line. Okay, we also have a retracement. 38.2 lines up closely to where price is currently at, and we're expecting price to reverse off the trend line and the retracement line, the 38.2 retracement. Okay, now pulling in another indicator, we have a stochastic, and I briefly mentioned this earlier about divergence. But here we are using kind of the same concept as divergence, but it's called a hidden resistance. So we have three swing highs on our stochastic that line up nicely. But on our price chart, if you compare, it's just a descending trend line. Okay, so subsequently price continued to drop just as we expected. So oftentimes, if you're able to identify price making a lower high, where stochastic is just reversing off that same resistance, It's kind of forecasting that it might happen another time, especially if you have a descending trend line. Okay, any questions so far? Okay, next we'll move on to the last scalping technique, which is the Nike tick strategy. So this also uses the Fibonacci tool, Fibonacci retracement tool that we used earlier. So here is where we drew the Fibonacci trend line. And that one tool can give us three different Fibonacci techniques. The levels that are greater than 100, the mid-range, which is what we saw in the previous slides, and the negative range, which is -27 and -61. For this Nike tick strategy, we use the levels that are greater than 100, namely the 127 and 161. Okay, so here's what it kind of looks like. So we place, okay, let's maybe look at this GIF instead first. So we've drawn out the shape. This is what you look out for. This is how you draw your trend line. Okay, and like I mentioned, we look at 127 and 161, and you can see price reacting off that 161 level. Okay. Um, Now let me go back to my previous slide. Okay, so this is an example of how it looks exactly. If you look at the yellow arrows, that's exactly what a Nike tick kind of looks like. So this is where we draw the Fibonacci retracement, our 161. You can see price reacting off of it. And then giving you that resultant reversal. So here we're telling you to look out for this V shape, and you should only use this when price has surpassed that 100 level. So that your tail end or the second movement should be bigger than the 100% retracement. Okay, so timeframes to use this technique, M30, H1, H4. Entry criteria can be on 127. Stop loss should be placed at the 145 level. Idea and validation can be placed at 138. Break even should be 11% of the recent move, 50% take profit, 11% of recent move, and a full take profit will be 22% of the recent move. Bonus, if you can find multiple Fibonacci levels or support and resistance levels to support your 161 or 127 levels. Okay, I'll answer that Ichimoku question in a bit, maybe after our slides. Okay, but are there any questions about this particular slide on the strategy? You don't have to follow these numbers, these percentages exactly. I think the important thing to take note of would just be the time frames to use this on, the entry criteria, this 127 that I've highlighted, stop loss, um, and your take profit. So this, yeah, the 50% is just a partial profit if you're interested in that. Break even is just, again, a trade management technique, an idea and validation as well. So these if you're not that interested in it, you don't have to use it. This is just a guide uh, to follow. Okay, so this is a short example. So if we're going in for a sell here because we're reversing off this level, and then you place your stop loss at this 145, and then we're going in for a sell towards um okay, I guess in this case I would maybe place my as 22% of the recent move. Um idea validation 138 here. So I guess I would just go in for a sell towards maybe the 50% here, or even towards the 61. I was thinking more the 61 because it's in line with a swing high here and a swing low. Okay, so if I had to put a level, it would be probably be here. Okay, now long example. Here we're going in for a buy. Um, so the so let me just maybe show you guys where the trend line was drawn. So the Nike tick is here. It's inverted now. So the 127, you can see price reversing off that level. Here we have a retracement, just a normal retracement that we talked about earlier. And it's mid-range, so we are expecting it to continue upwards. And then we very briefly talked about the negative levels as well. So those you can use as take profit levels as well. Okay, so I have a question in the chat. Is Ichimoku the same as moving average to measure trends? So you're right in that they both measure trends, but they do so in fundamentally different ways. So Ichimoku offers more comprehensive market analysis because there's more components to it. You're looking at trend direction, momentum, support and resistance levels, um, yeah, through the different lines, but and future projections. So like we mentioned, the cloud that projects potential support and resistance zones into the future as well. So it's also more versatile. Um, yeah. Whereas for moving averages, it's more simple. So it just calculates the average of the price data over a set period, and then you short term, smooth out shorter term fluctuations to identify the trend direction. And typically, the moving averages is considered a lagging indicator because it's reacting to prices instead of predicting them. So it might be slower to adapt in volatile markets. So moving averages is best for confirming trends instead of spotting potential trend reversals, like what we did for Ichimoku a few slides back. Okay, so yeah, so they do both tell us trends just in a different way and um offer different market analysis as well. So a good method would be to use both tools complementary, with Ichimoku for broader view and MAs for a simpler confirmation of trends. Okay, and that's it for today. That's all I have for you guys. Are there any other questions? No? Okay. Um, if not, that's all I have for you guys for today. Thank you guys so much for joining me. I hope you guys found this session helpful. Um, And yeah, I will see you guys again next week. Thanks, everyone. Bye. Thanks, Nazil.